Welcome back to In Case You Missed It.
I know what you're seeing when you open your apps today. It's February 11th, 2026, and the markets look like a total disaster zone. Bitcoin just slid under that $69,000 psychological floor. The retail sentiment on social media is basically the world is ending. And bitmine Immersion Technologies, ticker BMNR, is getting hammered, down about 7% and hovering right around $19.95. If you're just looking at the red candles, it feels like the sky is falling. But after spending the last 24 hours digging through the hard data and the latest filings, I'm here to tell you, I think we are looking at the ultimate bear trap. While everyone else is hitting the panic button, I've identified a massive divergence between the current price and the actual value. I'm seeing three massive signals that suggest the smart money isn't just staying calm. They are aggressively moving in while retail investors are being shaken out. We aren't just looking at a price dip. We are looking at a massive mispricing of an infrastructure supercycle. I've broken my research down into four critical pillars that explain exactly why I believe $19.95 is a gift, not a warning. We're going to look at a massive insider move that defies everything you're seeing on the charts, the surprising shift from Wall Street's biggest players, the rent collection model that's being built in the background, and the regulatory floodgates that are about to burst open. If you've been feeling the urge to sell, you need to hear this first. The first thing that jumped out at me in my research is what I call the insider whale strategy. Usually when a stock is tanking, you expect management to play defense. They preserve cash, they protect liquidity, and they wait for the storm to pass. But BMNR's leadership just did the exact opposite. Right in the middle of this market volatility, they executed a move that is so bold, it's almost counterintuitive. They didn't just hold their Ethereum, they doubled down. I found that in a single day, they staked an additional 140,400 Ethereum. To put that in perspective, even with ETH dipping to $2,000, we are talking about $282 million in liquid capital that they essentially chose to lock away. Now, why does this matter? Because staking at this scale isn't like putting money in a savings account. By staking, they are becoming validators for the network. They are subjecting themselves to lockup periods and exit queues. They've essentially burned the boats. They can't panic sell, even if they wanted to. This tells me that Chairman Tom Lee and the board aren't trading the daily chart. They are engineering a yield machine. Their total treasury is now sitting at roughly 3 million staked ETH, worth over $6 billion. This is a fortress balance sheet that actually generates cash flow, somewhere between $180 million to $240 million a year in pure, high-margin passive revenue. While the retail crowd sees a price drop and thinks loss, these insiders see a price drop and think yield opportunity. They are accumulating cash flow while everyone else is focused on coins. If you think this is just one company being overly optimistic, you need to look at what's happening on Wall Street. I've been tracking the institutional filings, and the data is shocking. Remember when the big banks called crypto rat poison? Well, the pivot is officially here. Goldman Sachs, a firm managing over $3.5 trillion, just disclosed massive crypto holdings. And the breakdown is the real smoking gun. They aren't just buying Bitcoin as digital gold anymore. My research shows they hold $1.1 billion in Bitcoin, but they also hold $1 billion in Ethereum. This one-to-one parity is a massive deviation from the old industry standard. Goldman isn't just looking for a store of value. They are betting on Ethereum as the settlement layer for the entire digital economy. They are treating it as infrastructure they need to own. They've also added positions in XRP and Solana, building a diversified Layer 1 basket. For anyone holding BMNR, this creates a massive floor. When you're a retail trader, you panic because you don't know where the bottom is. But when you realize that Goldman Sachs is sitting on $1 billion bag of the same underlying asset and they aren't flinching, it changes the entire math. The whales are net buyers. This 7% drop we're seeing is retail noise. The smart money is comfortable at these levels, and I'm choosing to swim in their slipstream rather than fighting the current. The third pillar is the most exciting because it's about the pipes and rails of the future. I've been looking at the tech build-out, and the news from Robinhood is a game changer. They aren't just an app anymore. They are launching a Layer 2 blockchain on Arbitrum to host tokenized stocks. Imagine trading Apple or Tesla 24/7 with instant settlement and no middleman. Now, here is the direct link to BMNR. Arbitrum is a scaling solution for Ethereum. Every single trade made on Robinhood's new chain has to settle back to the Ethereum mainnet. To do that, Arbitrum has to pay rent in the form of gas fees to Ethereum validators. This is a massive revenue funnel. As millions of users start trading tokenized assets, the transaction volume explodes. That volume creates massive fees, and those fees go directly to the stakers, the validators. BMNR is effectively acting as the landlord for what could become the busiest stock exchange in the world. They are collecting rent on the digital economy. While the market treats BMNR like a speculative tech play, it's actually acting more like a high-yield treasury bond with the upside of a tech disruptor. Every time a new platform like Robinhood builds on these rails, the value of BMNR's $6 billion treasury increases. They have positioned themselves perfectly to capture the gas fees of the future. Finally, we have to talk about the handbrake that's been holding this industry back: regulation. But that handbrake is about to be released. My research into the Clarity Act suggests that we are at a major turning point. This isn't just vague political talk. It's a specific strike against SAB 121, the rule that essentially banned banks from holding crypto for their customers. Right now, banks have to hold dollar-for-dollar reserves against crypto, which is incredibly inefficient. The Clarity Act is designed to remove that choke point, and the big banks, the Goldmans and JP Morgans, are the ones lobbying for it. They want in. Once this passes, we aren't talking about retail stimulus money anymore. We are talking about pension funds, sovereign wealth funds, and massive banking reserves finally entering the ecosystem because the legal risk is gone. Trillions of dollars are currently sidelined, waiting for this regulatory unlock. BMNR is already fully loaded and waiting for that flood. This is why the stock acts like a coiled spring. It gets hit harder during bad sentiment because it's volatile, but because they've been compounding their ETH holdings through staking, the upside potential is explosive. If you hold one ETH, you have one ETH, but BMNR's stack is growing every single day through yield, so I'm ignoring the noise, watching the staking wallet, and staying focused on the fundamentals. The price is what you pay today, but the value is in the infrastructure.
Thanks for watching. If you found this helpful, hit that like button and subscribe for more.